One of the oldest and best-known internet companies is planning to IPO, Yahoo. That's what CEO Jim Lanzone told the Financial Times, adding that the company is, quote, very profitable and ready financially. Yahoo has had an interesting and tumultuous history. The company went public in 1996 and quickly became one of the most popular websites in the world. At one point, it turned down a $47 billion acquisition bid from Microsoft. However, it has since regressed. In 2015, it was sold for just $5 billion to Verizon, which then resold it 6 years later at the same price to private equity giant Apollo. It's also had its fair share of management shakeups, with 8 different CEOs in its 28-year history. Now, we actually have some inside perspective on this story because Scott co-invested with Apollo back in 2021. So, Scott, what can you tell us about Yahoo's IPO plans?
So I'm not an insider. I'm not on the board, and I don't have any non-material public information. So let me just disclose that. I'm an investor. I co-invested with Apollo. So about 2-3 years ago, there's a couple things here. The first is we hate old people. We're ageist. What do I mean by that? When your grandparents come to the Christmas party with all of your friends, or someone's parents show up at a party, everyone's nice to them, everyone's polite to them, everyone wants away from them. And that is really old people scare us. They smell funny and they remind us of death, and they have trouble hearing, and we don't want to be around them. And that's a very harsh, reductive thing to say, and it's absolutely true. We love being around young people. Young people are interesting and they represent hope. You would pay a lot of money. You would pay a lot of money to have lunch or breakfast with Tom Brady or Gisele Bündchen. Having said that, people pay a shit ton of money for lunch with Warren Buffett, so maybe my argument doesn't hold. Anyways, I'm sticking with we're ageist.
Tom Brady's young? He just retired.
Well, he's young in my mind.
How about Odell Beckham Jr.?
Oh, okay, a guy like that. Anyways, you get my point. But we love hanging out with the hot young people, and we love hanging out with hot young companies. Nothing gets the valuations of a small, cool, new thing that's growing. It gets just a ridiculous. It can trade for billions of dollars when it has no revenue. So we have this wild bias towards youth and this wild bias against the aged. And the same exact thing is true in the investment markets. And that is, I've invested in every stage of capital formation or the life cycle of companies, if you will. I've been an angel, I've been in venture, I've been in growth, I've been in IPOs, I've been in mature companies, cyclical investing, then distressed, where a company is going through bankruptcy. Hands down, where I have made the most money is in distressed, because no one wants near them. The same reason that you want to invest in seniors' homes, these aren't sexy businesses, but they make a ton of money. And what you have with the distressed business, one of my distressed companies was Dex or Thrive, a Yellow Pages company that's kind of pivoted to CRM software. We bought this thing for 2 times EBITDA, and we all knew it's going out of business, but it wasn't going out of business in 24 months. The same way Blockbuster took 12 years to go out of business. So if you bought a franchise, you could pick one up for 2 to 3 times cash flow, and you made a lot of money. These things trade really inexpensively. And then we went and bought other Yellow Pages companies, laid off the majority of the staff, and as long as we cut costs faster than the revenue declines, the company was growing earnings and EBITDA. And that, I think I did 4 or 6 or maybe even 8x on that investment. The same is true of my biggest investment recently, and that is Enjoy. We bought it out of bankruptcy. It was highly distressed, a big bet, a lot of risk, tremendous upside. The same thing is true with Yahoo, and that is, I saw Yahoo as not a distressed property, but it was owned by the wrong player. Yahoo, in sort of a knee-jerk reflex gag reaction to AT&T buying Time Warner. And Verizon's like, well, we can't let AT&T get out of us, so it went and bought these digital assets, Yahoo and AOL. It didn't work. And the best assets to buy in terms of price are corporate orphans. Because Verizon, which does, $100 billion plus in revenue, and is worth a couple $100 billion, is like, I just want this shit off my plate. Sell it.
Yeah.
If we don't get, we don't want to wait and get a better price. We just want to be done with it. Get it off. We'll take the hit. Corporate orphans are literally the best purchases ever. And here's the thing, Yahoo was a shitty investment at $125 billion, but I was banking on the fact that at $5 billion, it was an amazing investment. And my thesis was incredibly complex, and it was the following. It's one of the 5 most trafficked sites in the world, and it's the only one of those 5 sets that trades for less than $1 trillion. I mean, whether it's YouTube or Meta, or Google, all of these things are trillion plus assets. And then there's Yahoo, which I think is the 5th or 6th most trafficked non-porn site in the world. And it's trading at, we had a chance to buy it at 5 billion. So I said to Apollo, I really want in on this. I love it. I can add value here. Yahoo Finance has been my homepage for, 25 years. With a public stock, they're going to be able to go roll up all of the remaining content, guys. I wouldn't be surprised if they acquire the distributor of this podcast, Vox, if they decide to get into the podcast game. And all of these things are trading at really, bargain basement prices right now. And they also do a very good job of monetizing that content. And then query me this: what is the 3rd largest company in a $150 billion sector called search? Well, we know who 1 is. 2 is Microsoft. Number 3 is Yahoo, and they make a shit ton of money in search. So for a lot of reasons, this is just, I'm very excited, Ed. I'm very excited. Distressed, growing, got in at a great price. I really like Jim Lanzone, the CEO. He strikes me as an adult. He's also quite handsome, which I think is important in a CEO. I think that's very important. And
fundamentals.
So I got into this thing, and it's already like, I see the financials on this company. It's already a crazy winner. They got this, and this is public. Did
they share the financials with you when you invested, or do you get to look at the financials as an owner of the stock? Like, have you received a document outlining them?
I saw the financials when I was investing. I haven't kept up on the financials of the company, and this was public information.
Do you remember roughly what the earnings multiple was?
I think the company was doing somewhere between 5 and 700 million in EBITDA, and was we bought it for somewhere between $4.5 and $5 billion. But here's the thing, Ed. It had about $1 billion in cash, and then it immediately sold Yahoo Japan for, I think, about $1.5 billion. So you basically bought this company for about 3 or 4 times EBITDA, and they've been growing EBITDA. So I mean, the way private equity works is you make a capital commitment, and then they call on that capital commitment. They never called the full amount of the capital because they didn't need it.
Right.
So this is going to be a home run. And the way you measure the success of a private equity or of any investment is the internal rate of return, meaning how long did it, how soon and how much money did you get back, right? So you'd rather get $20 back on $100 in a year than $30 back on that 100 in 2 years, right? It's how much and how soon do you get your money back. This thing's going to have crazy IRRs, and it's going to have a public security to go start buying all the cats and dogs and digital media that don't have the scale. So anyways, I absolutely love this thing. And again, see above, animal spirits returning to the markets. You watch, this is going to be a big IPO. It's going to be, and it's kind of internet history for me. It's sort of like when John Travolta shows up in Pulp Fiction and has a kind of a, his career is reignited again. I love the fact that Yahoo is back. It's like, oh my gosh, who would have known that Michael Keaton would be in, win the best Oscar or whatever. So I love this thing. And I think there's some real investment lessons here. Find the shit no one else wants. The hot young thing always trades at a crazy multiple. It's ridiculous how much unearned attention hot young people get and how much we shun older people when they have a lot of value to add. And it's the same is true of companies. Older distressed companies are the best place to invest.
I was also going to ask, what kind of return are you looking for? I mean, you're talking about the IRR. Are you planning on selling at the IPO? Is there a price target you're searching for? What's your exit strategy, if any?
I'll look at the value. It's totally based on the valuation. I'll look at the valuation of the IPO. I'll look at how the stock trades on the offering. I'll look at the metrics and the numbers, and I'll decide whether I want to hold or not. But this is, this is a dream private equity investment. They don't call the majority of your capital because they can, refinance the company right away and sell pieces for a lot of money. And I mean, it's just, but I'll look at the value. Whether or not I sell will be based on valuation, but I'm inclined, unless the valuation is just crazy high, to hold. I like management. They're growing. and see above fifth most traffic website in the world.
Mm-hmm. And finally, just some sort of M&A, tech M&A history. We're talking about Facebook, which feels like probably the greatest acquirer of all time. Yahoo might be the worst. So they bought a web hosting service way back in the day called GeoCities for $3.5 billion, which later shut down. Then they bought an internet radio company, broadcast.com, for $6 billion, shut down. They bought Tumblr for $1.1 billion and then sold it at a 99.77% discount for $3 million. Facebook makes it look easy. Yahoo is sort of case in point that it isn't. But from your experience on corporate boards and just running companies in general, what does the acquisition process usually look like? And what does it take to make a successful one, especially considering the fact that the CEO has stated that M&A is going to be a big part of his strategy moving forward?
Well, you said a lot there. So a couple of things. One, as someone who's, supposedly knows something about brand strategy, people often say, specifically the CMO or the person who feels like they should only be the one making decisions around brand and marketing, that brands are really fragile. I find that's not true. I find that strong brands are really enduring. It takes a lot to kill them. They're like Jason. Like, you can do anything to this thing and it shows up with a hockey mask and it's back, right? Do you remember Cartier, which is one of the best luxury brands in the world? They were putting their brand on the side of Lincoln Town Cars in the 80s. I mean, you can really
I did not know that. That's crazy.
You can really try to fuck up a brand and it still might survive. This is what Yahoo, a global brand, has survived. It's survived arguably the worst CEO in tech in the last 20 years. Marissa Mayer, who everyone thought was, keep hope alive, a great backstory, Google, articulate, a terrible CEO. Took revenue down 20%, took EBITDA down 50%, and managed to walk away with $250 million. Hired her buddy from Google. He was fired 15 months later. She agreed to a severance package where I think he got something like $130 million or $200 million in severance. Almost managed to fuck up the tax structure of their Alibaba stake, which was worth more than the entire company. The company became a tracking stock for Alibaba. And you referenced probably the worst acquisition in history. And I'm not revising history here. This is true, and it's on video somewhere. I was invited to speak at something called P&G Signal. P&G gets all of its top leaders together around the world, and they bring in a bunch of people to speak to P&G. And the most important, a lot of people show up because they all want to sell ads or something into P&G. And I was on stage, and Instagram and Tumblr had both been acquired in the previous 90 days. And I said, best acquisition of the year, Instagram, worst acquisition, Tumblr. And you know who spoke after me?
I don't know, Marissa?
Marissa Mayer was behind me, spoke after me. But essentially, it didn't take, and I knew this through firsthand usage, Tumblr was a porn site. And once they stopped, and Union Square Ventures basically did a masterful job pretending this chicken shit was chicken salad, selling it into their buddy Marissa for $1.1 billion, and it was basically a porn site with some design pages. No individual has made more money off of porn than Fred Wilson or a firm of Union Square Ventures. Tumblr was a porn site. They sold it for $1.1 billion. The moment they stopped the porn under pressure from advocates, its traffic dove and it was sold for $3 million. It is hard to find a company that goes from, there's been companies that have lost a lot more in gross value, right? Twitter has lost probably $40 billion in the last 6 months. But it's hard to imagine a company losing $1 billion plus acquisition going to 3 million, basically saying it's worth nothing. We bought nothing here. So Yahoo has endured one of the worst CEOs of the last decade, one of the worst acquisitions, and yet it endures. It has a global brand. People still show up to it. Do you use Yahoo, Ed?
No, that's why that top 5 global total traffic was just shocking to me. Never.
You never on it, not for finance, not for anything.
I used to use it for finance, but then we started using other tools.
Yeah.
But yeah, no, not really.
Well, I need you to start.
You use it?
I need you to start. Okay. Yeah, I use.
You're good. You can exit soon.
I love Yahoo Finance. Yeah. But anyways, Yahoo has endured, but I mean, it cost them. They went from 125 billion to 5. But my guess is this thing comes out. I mean, I was looking everywhere to try and see where they think the market valuation is. But my guess is this thing comes out somewhere
Right.
between 10 and 20, and Apollo
Yep.
just prints an enormous IRR number. I love this. I absolutely love this.
Yeah.